Investors are bracing themselves for a prolonged period of market volatility and economic uncertainty. This is a pivotal time in the alternatives investment industry. What was seen as a risky, niche corner strategy has now gone mainstream. Alternatives are no longer just for large institutions. They are an essential element of individual investors' portfolios. Over the last decade, assets under management in the alternative investment space have increased to 9.5 trillion. This represents roughly 12% of the total industry.
The private markets are growing twice as fast as the public markets, and that is expected to continue because the private markets today only account for about 6% of the total markets. The growth of the private equity market comes with a number of challenges. I think there are three I would like to highlight. First one is pricing. There's fierce competition between these fund managers. The second challenge is access, and that's primarily the case at the smaller end of the market. There's so much money chasing these small managers, they can really select their investors. And the final point is the macro environment. Private equity fund managers are less concerned about rising interest rates. They are more concerned about the growth outlook.
To not take risk is actually risky because you may be missing out on an opportunity, and if you have a good risk return, which is what we look at, which is the Sharpe ratio, then you should go ahead and take the risk. Hedge fund managers have exactly that problem, is that they need to basically do, which is adapt or die. And we, as hedge fund, examiners or due diligence performers, need to do that as well. I would say our focus is different in that we basically look at managers who are smaller. We don't necessarily look at the marquee names. We feel that the performance from the smaller firms will definitely be much better from that of the larger firms as a general rule.
The main challenge is really it's a huge universe, and on top of it, it's an illiquid asset class. So if you invested, committed into a private equity fund, you're in for the long term. You better perform a proper due diligence at the beginning, because it's difficult to get out.
As David Swenson of the Yale Endowment Foundation famously said, the most important distinction in the investment world is not between institutions and individuals. It's between investors who can make good, active investment management decisions and those who can't. And this is particularly important in the alternative space.